People see the largest companies every day. The big banks, the enormous tech empires, energy companies and consumer goods. And behind them are their owners, the large pools of capital who vote on what they do. For whenever a public company reaches a major decision, it must be voted on by its shareholders. These shareholders are very often large pension funds, endowments, insurance companies, healthcare systems, and sometimes the investments of private investors. And it seems like the power structure of our economy should end here, the vast companies and their owners. Yet within the world of institutional investing, there are layers and layers of consultants, a whole other meta layer, wielding vast influence over the entire economy. For institutional funds, these could look like investment consultants, advising on what investments they ought to make. Within private markets, there are often dedicated private market consultants, who in turn wield great influence over our private companies, acting as the gatekeepers for the private equity funds. Yet these sorts of consultants mostly deal with the investment side, making policy recommendations, helping investors rebalance and decide what they need. But there is another type, one which has far more say on how our businesses operate. Two companies in particular, which in aggregate are the most powerful voters of all the largest companies. Imagine if there were only a couple people who, for nearly every publicly traded company, held vast numbers of shares, acting as super voters across the entire economy, making decisions for all of those businesses. Well, certainly we would pay attention. Yet these two consulting firms, only two companies who control nearly the entirety of the market for consulting on share voting, surprisingly slip under the radar. These companies are Institutional Shareholder Services and Glass Lewis and Company. And if you've ever watched seemingly every large company go nuts all at once, inexplicably, they are the ones who made them do it. So let's take a look at these companies and where they came from. Because surely two companies deciding what all of the largest companies do raises a bit of a concern. Our story begins in 1985. Institutional Shareholder Services is established by Georgeson & Co. It was started to advise institutional investors who had to make decisions on the shares that they held, geared towards funds like pensions and endowments. The purpose was to be an expert team to come in and tell them what different decisions meant, what the implications of voting their shares different ways might mean, and feeling that this was saving time, effort, and leading them to better decisions, demand would rise rapidly, with ISS separating in 1994 to become an independent company, before being acquired by Thomson Financial in 2000. By this point, their consulting services were a very big business, and they were not the only player, though they were the largest. Mostly they were fairly useful. Imagine if you had to vote on hundreds of shares, and particularly if you're a large shareholder, knowing that your vote had significant consequence. You'd be quite happy to have someone come in with a standard form saying, "These are the questions up, this is what they mean." And in 2003, the SEC's proxy voting by investment advisors rule would solidify responsibilities of proxies, requiring that any proxy voters vote in the interests of the shareholders. Yet one very notable thing that this rule did was allowed proxy voters to rely on these consultants. Outsourcing your decision-making to ISS was considered to be well within the bounds of your responsibility. And with this rule setting in, the market for proxy consultants would explode, with an enormous growth in demand over the following years. By 2005, as the market for these consultants was expanding so rapidly, a new competitor would emerge, Glass Lewis and Company. At this point, Institutional Shareholder Services was so dominant in the industry that it was thought it might be time for some competition. Early on, Glass Lewis would grow quite quickly, establishing substantial market share with mutual funds, marketing itself by emphasizing its independent analysis. They would grow substantially over the following years, expanding into international markets, acquiring the Australian Corporate Governance International in 2006, and the American company Washington Analysis in 2008. And throughout the 2010s, The two companies would truly dominate the market, becoming effectively a duopoly throughout the 2010s and 2020s, ranging between 90 to 97% of market share. One thing that really fueled their rise was the government. As financial markets would become more and more regulated, many institutional investors found that the best way to indemnify themselves was to use industry-standard third parties. For example, a pension fund, fearing that they might run afoul of ERISA retirement laws, seeking out a pension consultant that everyone uses, so that if they make a poor investment decision, they could say, "Hey, we did our best. We used the guys you're supposed to use." This would be much the same for voting shares. In 2010, the Dodd-Frank Act would require non-binding advisory shareholder votes on executive compensation. This would rapidly increase the presence of companies like ISS and Glass Lewis, and their influence would be massive, where companies who had a large number of their shares being advised by these companies ended up with executives, on average, being paid 28% less. Glass Lewis would make a major expansion move in Europe in 2015, acquiring IVOX, and increasingly during these years, social cause voting would rise, especially with ESG scoring becoming prominent. And with these two companies maintaining a duopoly and existing internationally, they would begin exporting ESG across the world, imposing it on every large company that they could. It was a global, unified program, all being run through two consultants. Yet they wouldn't stop there. The 2010s would see them becoming more and more activist in the businesses that they held sway over, using their influence to become a sort of cryptic board of directors for the world. And as this ramped up, they would draw more scrutiny. And by 2020, the SEC had taken notice and would adopt the Proxy Advisor rule, noticing just how many shares of the largest companies in the United States weren't even being reviewed by the institutional funds. They were using robo-voting, simply automatically instructing ISS and Glass Lewis to vote for them. This was becoming a major concern, and the SEC would impose rules demanding that proxies be much more careful. In the early 2020s, it would only heat up, with the consultants going all out on diversity, climate, and social goals. By this point, they had become very hated by many in corporate America and many of the other shareholders, as they were actively harming the companies, making terrible corporate decisions, all for the sake of the activists who ran the firms. And in the past 2 years, major funds and entire US states have begun suing these firms, with the firms agreeing to make some changes and cease their one-size-fits-all approach, tailoring their recommendations to different investors. But it still remains to be seen what they will actually end up doing. And as of now, even though a fight is brewing against their influence, they still largely operate as a duopoly and still hold enormous sway, particularly when they are aligned with index fund companies like BlackRock, Vanguard, or State Street. So with their story understood, let's take a look at how they use their influence, what some of those moves were. These companies are very powerful. Together, they form a duopoly. Within the United States, Institutional Shareholder Services maintains coverage of between 8,000 and 9,000 public companies, including all companies in the Russell 3000, while Glass Lewis maintains coverage of a little over 4,300 companies, with the two both reflecting around 90% of all publicly traded companies in the United States. Globally, ISS covers around 40,000 companies, or about 90% of global market cap, while Glass Lewis covers a bit over 10,000. ISS processes 8.5 million shareholder ballots, involved in the voting of 3.8 trillion shares. With US investment companies, ISS has $26.8 trillion under advisement, while Glass Lewis has 23.6 trillion they advise. Globally, ISS manages between 30 and 40 trillion client assets, while Glass Lewis a bit over 40 trillion, Both offer robo-voting, where you functionally just hand off your vote to the company. Together, this accounts for around $5 trillion. According to research from Harvard, when ISS makes a recommendation to vote against a proposal, the proposal will experience a 20% drop in support, while in the case of Glass Lewis, that effect is about 13%. It has additionally been found that opposition to a vote from one of these companies is correlated 51% with lowered support amongst institutional investors, while that effect is only about 2% for retail, covering around 90% of global market cap and able to cause gigantic swings in shareholder votes. These companies have been given extraordinary power. So let's look at some examples of them using this power. In 2021, activist investor Engine Number 1 would launch a proxy fight against the board of directors of Exxon. The investor held only 0.02% of the company's shares. It looked like it was entirely doomed to fail, as this was an investor with very little influence, who wanted to overhaul the board, aiming to remove 4 members. What made it look so wild is that their objection was that Exxon didn't have a sufficient energy transition plan. They didn't have a plan to make their oil company green. Now, would any serious long-term investor in an oil company really object that they don't have a plan to become a green energy company? No. Yet, the investor received the backing from ISS and Glass Lewis. ISS would recommend to its clients voting for 3 of the board members proposed by the investor, while Glass Lewis would throw its weight behind 2. In the end, the activist investor won, with the dissident nominees winning their seats, beginning a period where ExxonMobil would overhaul its climate policies. In 2024, the hedge fund Politan Capital held around 2% of Masimo's shares, an American medical technology company. The fund would target the company's CEO, alleging that he was mismanaging the company, seeking 2 board seats. By this point, it looked like Politan would lose, and that the founder CEO would win, retaining the board as it was. Yet, both ISS and Glass Lewis would issue scathing reports against the CEO, recommending against his re-election, and backing the hedge fund's candidates for the board. Only one of the 2 seats would be won. Yet, going from a situation where it looked as though none were even up for grabs, to this on the back of aggressive reports and the recommendations of the Proxy consultants, would demonstrate just how much sway they had. The CEO's control was diluted, triggering a full board reset. The company would subpoena ISS and Glass Lewis for their internal communications, alleging collusion with the activists, as well as violating their duty, acting on bias. The show of influence and the aggressive attacks would garner substantial criticism, with critics calling this an abuse of monopoly power. Their power is particularly illustrated in situations where votes are tight. Another large company example would happen in 2018, when ISS and Glass Lewis would tip the vote of the shareholders of Procter & Gamble in the favor of activist investor Nelson Peltz. Initially, it looked as though Peltz would not win his vote, yet with the support of ISS and Glass Lewis, his fight over a dissident board seat would succeed by only 6,798 votes. In 2020, a shareholder proposal at DuPont was put forward for a vote. The issue, climate lobbying disclosure. The board expected fewer than 20% of the votes would join in support of the proposal. Yet after ISS and Glass Lewis threw their support behind it, it received 54% support, with DuPont noting that the ISS benchmark report mobilized 40% of passive investors. In 2024, there would be what appears to be a 26% swing during a vote of Lazard shareholders regarding DEI disclosures. In 2025, there would be a proposal regarding Scope 3 emissions targets for the shareholders of ConocoPhillips. Historically, such proposals had never received more than 10% support. Yet after ISS threw its weight behind it, it received 31%. Similarly, in 2023, a racial audit would be proposed at Alphabet. Alphabet expected a support of less than 12%. Yet when ISS threw its support behind it, it moved to 38%. In 2025, the Sierra Club would propose a fossil fuel financing phase-out amongst the shareholders of Citigroup. The Sierra Club would admit that it had used ISS benchmark reports to draft the resolution. When testifying before Congress, Citi CEO Jane Fraser would testify that proxy firms are now de facto co-regulators. Their power doesn't only exist within swaying substantial votes. Much of the time, they act as institutional momentum, nudging companies along. ISS and Glass Lewis show very strong interest in climate-related matters, very often being the most powerful driving force for climate-related policies, even getting investors of energy companies to, in some cases, vote against the interests of their business. They have been perhaps the ones at the top of the heap when it comes to driving diversity, equity, and inclusion policies, particularly as one of the most emphatic issues is their board diversity index, requiring at least 30% of board members be women. In 2025, Missouri would lead a letter signed onto by 18 states, accusing these firms of enforcing racial quotas by proxy. There have as well been many instances of political collusion, showing them to be very clearly aligned with activists. This would lead to an SEC rule proposed in July of this year, that such firms disclose communications with activists. Yet, how can we really know that this power belongs to them? How can we know, as much of this relies on counterfactuals? Well, using data derived from multiple sources, as well as Glass Lewis internals, analyzing the influence of ISS, it has been found that on average 18% of total shareholder votes arrive after ISS reports. It has additionally been found that Vanguard, BlackRock, and State Street vote with ISS 94% of the time. It has been found that management wins 94% of uncontested votes, yet that number drops to only 38% when ISS opposes them. And on mergers and acquisitions deals, when ISS is in opposition, deal completion drops by between 12 and 15%. Opposition to these companies has been rising, and rising by a lot. In 2025, the National Center for Public Policy Research would propose a DEI rollback for the shareholders of Home Depot. ISS and Glass Lewis would oppose this, as DEI is the thing they care the most about. The proposal would fail, yet as a result of this high-profile vote, 13 state attorneys general would file an amicus brief with the SEC, accusing these firms of illegal coordination with ESG rating companies. Increasingly, it appears as though the ESG rating companies, those who score companies on how well they meet ESG targets, a score which is quite important, as a result, this may affect their inclusion in certain investment funds, the ability for certain institutional investors to buy them, as well as the interest rates they pay on loans, are working quite closely with the index fund companies, those like BlackRock, Vanguard, and State Street, the vast administrative companies who hold so much of the American economy, and the proxy consultants, all forming something like a cartel, a very powerful monolith of enforcement, where things like ESG and DEI happen, because those are the firms that make them happen, and they have overwhelming power. A quite interesting story is what happened when they went up against perhaps one of the few bigger giants in corporate America. The proxy consultants would support a proposal of climate risk disclosures, which was put to a vote of the shareholders of Berkshire Hathaway. It looked as though it was a proposal that would have very little support. Yet, rallying their forces, they were able to garner 26% of the vote. They lost. But it's worth noting that they were going up against the weight of Warren Buffett. Most of the time, companies do not have nearly as many defenses, as annually, dozens of votes amongst the largest American companies are swayed, particularly on matters like DEI and carbon initiatives. And almost always, ISS and Glass Lewis are aligned, or at least do not stand in each other's way when one of them is taking an initiative. However, there is one high-profile and very curious counterexample. In 2024, activist hedge fund manager Nelson Peltz would seek out 3 board seats at Disney. He wanted Disney CEO Bob Iger gone, citing losses from the streaming business and criticizing corporate governance. Glass Lewis would back Nelson Peltz. However, ISS would back Iger and Disney's board of directors. The Disney board would win, and win with around 94% of the vote. Yet what is quite interesting is the extremely high activity of voting in this case, with over 1 billion shares voted. This would capture quite a lot of attention, as the sheer scale of activity and the outsized power of the proxy consultants fully on display was something that simply couldn't be ignored. Back in 1980, large funds like pensions, mutual funds, and endowments controlled around 30% of US equities. Yet today, that number is over 80%. And when one looks at the sheer scale of the largest index fund companies, how much of investment is passive in things like S&P 500 or Russell 2000 ETFs, as well as the sheer enormity of these consultants and their one-size-fits-all approach to recommending votes, not to mention the number of robo-proxies, it's become evident that the largest companies of the United States are controlled by a very small number of people, all concentrated in really just a few firms. Yet now, the fight against them is really ramping up, particularly in response to their one-size-fits-all approach, how they appear to be putting the interests of shareholders and companies behind political and social concerns, the lack of transparency these companies have and how they reach their recommendation decisions, and their ESG and DEI policies. They have made some real enemies. In 2025, Texas Attorney General Ken Paxton would begin an investigation into both ISS and Glass Lewis for misleading shareholders by issuing voting recommendations favoring companies with DEI, gender quotas, aggressive climate policies, and other social and political motivations at the expense of the companies and their investors. And the backlash has grown all across the country, including a 2025 U.S. Senate Banking Committee letter targeting specifically these firms. Texas State Senate Bill 2337 from June 2025 required proxy advisors to disclose when recommendations rely on non-financial factors. Factors like climate, gender quotas, or social goals. The idea being that if a proxy firm recommended based on something other than the interests of the shareholder, then the investors had a right to know. Both ISS and Glass Lewis would sue to block enforcement of the act, securing a federal injunction in August. Currently, the trial for this case is set for February of 2026. Many in Silicon Valley, particularly on the venture capital side, have begun rallying against these firms as well, particularly led by Elon Musk, who has gotten into fights twice with these firms regarding his executive pay package. Major tech investors have pointed out these same issues, where there's a very widely held sentiment that they are directly sabotaging their businesses, in some cases preventing them from growing, all for activist agendas, with Elon Musk referring to them as corporate terrorists. So what happens next? Next is likely a lot of fighting in the courts, as well as more and more clients beginning to question their relationships with these firms. It is also quite likely that we will see more and more businessmen vocally opposing these firms, in much the same that there has been broad social opposition to companies like REITs, engaged in buying up large swaths of residential real estate, and index fund companies, holding enormous chunks of the American economy. We appear to be entering into a period where attention is turning to the proxy consultants? Will they simply change their behavior, compromise, and perhaps retire some of their external goals? Will the SEC get involved and regulate more aggressively? Will major investors drop them, just as we have seen state pension funds mobilized to act against the index fund companies? Or will they change form, continuing their power but with a degree of subtlety? And they would go away if people just stopped listening to them. One thing is for sure, that the intensity of this fight is increasing, and with so much power vested in two companies that hardly anyone knows the names of, this could turn out to be one of the most fascinating stories, not only in corporate nor financial history, but the history of how power itself works.